Today, I want to talk about how 1.87 billion shares of Mullen were traded in one singular day, when the float is only 243 million, when you factor that many of these shares are locked away, held by retail investors, insiders, ETFs and long funds. That's very few shares these shorts actually have to work with, but they've still been illegally shorting billions of shares every single day. So stay tuned and let's make some money. And now to dive straight in with the key information. So, the hedge reaper tweeted saying Mullen traded 1.87 billion shares, but the outstanding shares is just 243 million. Gary Gensler, do you think this could be a problem? You can see from this screenshots, Mullen is showing volume of 1.87 billion shares. And then on the next screenshot, the number of shares outstanding seems to only be 243 million. You may say, Tom, that's a weeble screenshot. Maybe that's just a data glitch and not that many shares were actually traded. But even if you look at different data sources, it still confirms that billions of shares were traded in one singular day. And not only that, it shows that 1.1 billion shares were actually traded off exchange, with 61% of the entire daily volume. For a stock that only has a float of 243 million shares, with at least half of these shares locked up by insiders, ETFs and retail investors, these shorts still managed to pass around the relatively small number of shares hundreds of millions, if not billions of times. This is how these shorts and hedge funds ladder down stocks like Mullen, AMC, GameStop and many others every single day, just passing around a few shares between themselves millions of times, if not billions of times every day to bring the price down. And as Joe tweeted, he said Mullen is just another poster child for just how messed up this fake cesspool of a market is. He said 134 million share float, maybe that's when you take out the ETFs and insiders, and it's traded 2.5 billion shares in just 1.25 trading days. This goes to show just how messed up the market is, but it also goes to show how desperate these shorts currently are. In the past, these shorts at least tried to cover up what they were doing with their market manipulation, but now it's getting more and more blatant and more obvious in their desperation. It's now got to the point the only way they can keep these stocks like Mullen, AMC and GameStop under control is on specific days, trading multiple times the float just to ladder the stock down. This isn't just a case of selling the float multiple times over the space of 2 years. This is a case of selling the float multiple times over in one singular day. Now you may know that Mullen has been working with share intel to try and combat synthetic shorting, so I wanted to talk about that, give a bit of an update and give my thoughts on share intel. Now I have spoken about share intel on the channel multiple times before, and while I do think they can be somewhat useful, I almost think in some instances they can cause more damage than good. We know, for example, Roger Hamilton has said that since he's become more vocal on synthetic shorting and tried to fight back, his company has actually been targeted even more by these shorts. Sometimes just keeping your mouth closed like Adam Aaron is doing is actually the best way to protect your company. And while share intel does obviously investigate synthetic shorts and try to combat synthetic shorting, they haven't actually yet caused any short squeezes. Now Mullen has actually provided an update on their illegal shorting investigation with Wes Christian and with share intel, so I wanted to give a little bit more of an update and talk about what I meant when I said that share intel hasn't yet caused a short squeeze. Now it says here, based on reports Mullen has received from share intel, the company believes it may have been the target of a market manipulation scheme involving illegal naked short selling of its common stock. Now Wes Christian has successfully prosecuted and collected millions of dollars in aggregate damages on behalf of their clients from broker-dealers, market makers, hedge funds and asset-based lenders who have engaged in such market manipulation schemes. So Wes Christian has indeed proved illegal synthetic shorting in courts and actually won settlements for his clients. But so far as I'm aware, while he has won millions of dollars for his clients, which are likely the underlying companies, he hasn't yet caused any massive short squeezes in companies which have forced the shorts to close, and hasn't actually yet made the regular retail investors hundreds of millions, if not billions of dollars. The Mullen CEO has said we now have enough intel to have the law firm actively investigate and, where justified, take action against any market manipulators using naked short selling, spoofing or other illegal acts. And while that is great for Mullen, and Mullen may end up willing millions of dollars, if not hundreds of millions of dollars, it doesn't really do much for the everyday retail investor. Obviously, what we need is a short squeeze, not just a lawsuit where a few $1,000,000 is won. But Wes Christian has said that while mainstream media will continue to ridicule those standing against fraud in the market, as seen with Patrick Byron in the past, investors should still continue to raise awareness. And despite the media's attempt, like Forbes' attempt to brush the problem aside, naked short selling is a very real thing and companies are paying the price for practicing it, at least according to the SEC. I guess we'll have to see if the SEC does go after any more hedge funds for synthetic short selling like Savvy Management LLC and its managing partner Hal D. Mintz. Hopefully they'll actually step up their investigations into some of these larger hedge funds and market makers like Citadel Securities. As I've said, considering their fraud is becoming more and more blatant, I don't actually think it would be too hard for the SEC to discover synthetic shorting at Citadel. And I think when they peel back the covers and unveil just how big the synthetic shorting problem actually is, I do think we'll see many top executives go into jail. And when that happens, we will indeed see massive short squeezes. Frank tweeted saying, remember when the shorts brought Overstock down from $75 per share to just $2, but then it ripped to well over $100 per share. He said, I do. He said the price of AMC doesn't matter because we are way bigger than Overstock. And you've got a meme here from The Simpsons where Principal Chalmers is saying maybe it was wrong to short a stock more than 500% and to short sell the float 5 times over in an attempt to bankrupt a struggling company. But then he says, no, it's the retail investor who likes the stock that is definitely in the wrong, and then it's those guys that are the problem and those retail investors that are the criminals, according to these hedge funds. Frank has also said that Bank of America, Wells Fargo, JP Morgan Chase and Citigroup have actually compiled the losses due to bad bets in the bond market. The Financial Times is saying that 4 US banking giants now have over $205 billion in unrealized losses sitting on their balance sheets. Obviously, these banks made some really bad moves over the last year and are now really paying the price for it with $205 billion in losses. But what is actually quite interesting is that remember Citadel was also making bad, heavily over-leveraged bets in the stock market and could therefore be facing even more significant losses. While at the moment these are unrealized losses, if their losses get too large, they will be margin called and forced to close out of not just their short positions, but their bond positions too. And that is why, as Unusual Wells tweeted, they said the SEC is set to impose a slate of new rules on money market mutual funds on July 12th, which are meant to prevent the kind of outflows that occurred in March 2020 when the onset of the pandemic roiled markets. So this is basically new rules to try and protect these large banks and protect these market makers from giant outflows that would likely margin call and bankrupt these funds. As Bigham's added, he said they're trying to get ahead of the death spiral, but they can't. He said they know that they will keep spending and that the rates will keep going up on the bonds and that everyone will run to the bonds thinking it's a new savings account and that banks will not be able to keep up with rates, but they can't have a run on government debt in the future. Obviously, the government is trying to prevent a run on these banks and market makers trying to get ahead of the death spiral, but they can't. It's already too out of control, especially in smaller regional banks and now in mid-sized banks, and it won't be long until it starts bringing down even the largest banks as well. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.